Is it too late to remortgage, or should you wait? This graph shows the gross advances of mortgages over the past few months. As you can see, a lot of people were smart enough to remortgage their houses in the first 2 quarters of 2022, with the steep increase on the yellow line as people hunker down and weather the storm ahead. They saw the rate rises coming. At the same time, home movers on the red line decreased as people sit and wait. But don't kick yourself too quickly if you think that you've missed out. Now, I asked my audience through a YouTube poll when their current fixed rate mortgage ends. Now, my audience might be a little bit skewed, but my audience's mortgages on their fixed terms expire for the majority after 2 years, which is good for a lot of people. That means they can sit tight and see what happens over the next crucial 2 years. Is it too late to remortgage? Should you wait? Should you sit on a variable rate mortgage? Should you pay the early repayment fees and lock in now before rates may go up later this year? There's a lot of talk about mortgages right now. Let's explore the data to understand the facts and figures on what's going to happen in the mortgage market this year. And I'll ask my mortgage broker the difficult questions that you really want to know. The first problem to cover is the Bank of England's warning about the 2023 mortgage ticking time bomb. Unfortunately, the ship has already sailed. You won't be getting a cheeky 1.5% fixed rate for the next few years. And if you're part of the 33% of my audience who have a fixed rate expiring in the next 12 months, times are going to be very hard. There's a very difficult decision ahead. But you're not alone. Over 2 million people this year are expected to come off of their fixed rate mortgages. A lot of those would have been sub 2.5% interest fixed rates, which means that the average repayment hike on the current interest rates of around 5.5% to 6% is a minimum of £250 more every single month, or over £3,000 extra every single year. It's a decision for a lot of people now. Is it worth paying off your mortgage early and paying early redemption charges, or waiting and going onto a variable rate mortgage? You could lock in now on a new rate. It's going to be a higher rate and it's going to be tough, but it is stable, and it means that you've got certainty for the next 1 to 2 years. And if you can manage it for 24 months, then it might not necessarily be a bad decision. It would mean you're protected from any fluctuations or volatility in the market over the next 24 months to see through the worst of these times. There's a fear that interest rates could go up even further. So do you lock in now at a higher rate in the hope that things start to cool down as we go later into this year, but with the risk that things might be higher? You're damned if you do, and you're damned if you don't. The Bank of England do try and release a report on this every single month, but the problem is it's very hard to predict the future, and there are so many external factors impacting UK inflation at the moment. The bottom line is that yes, it is really hard right now to get a mortgage. It's very expensive and very unaffordable for a lot of people in the UK. The only way around it is if you've got a lot of equity to minimize the actual loan amount you need as a mortgage, or if you're a cash buyer. However, the Bank of England are starting to signal that they're not expecting the bank rate to go much higher than what it is today, currently at 3.5%. They expect it to decrease in line with inflation, which is expected to start to go down. So much so, the Bank of England actually predict that the inflation rate will decrease as sharply as it rose in 2022. Their original analysis expected a peak of around 11.5% at some point in 2023 before starting to go down. However, looking at the Office for National Statistics, we've already seen a peak inflation rate of 11.3% in October, before it then went down to 10.7% in November. So there's a theory that we're already at the peak and we're just starting to get over that hill now. But it also means we could be at what's known as the curse phase, the phase where fear is at its highest that things could get worse, but also if you locked in now on a new fixed rate, you could be locking in at one of the highest rates seen in the past and in the future for the next few years. Annoyingly, inflation rates lag behind by 1 to 2 months, so I can't give you the most accurate figures as we go into this year. I wanted to dig into this more and ask my mortgage broker about his thoughts on the current market. Andrew, welcome to the channel. The Bank of England say around 2 million people are expected to come off of their fixed mortgages this year and are worried about high interest rates, whether they're moving or remortgaging. If I was going to remortgage now, what are my options? Should I fix in the hope that rates go down in the future, or lock in early now?
So I get this question quite frequently, and we're looking after a lot of clients at the moment in the same situation. So what's available for you at the moment is we can actually apply to fix a product for you now, and if interest rates come down within the time period between now and when you actually take effect, we can switch you to another product. So it's win-win for customers. So if you fix now, commit to something, and it doesn't start yet, you've got the time period from there until it does to switch to another product. Now, if rates carry on in a different direction, for example, they go back up, you're protected. But if they come down, you'll be able to benefit. So it's a very great time for people to sort of have a look at committing to something as early as possible and then getting the benefit of both worlds.
So what's going to happen over the next few months according to the Bank of England? Well, on this table here, the Bank of England, in their latest forecast summary, they expect in 2023 that the bank rate could be as high as 5.2%. However, in that same time, they also expect inflation to be half of what it is in Q4 2022. This means they'll be hoping to increase the interest rate before then starting to decrease it as we go into 2024 and 2025. So on one hand, it would suggest that locking in a 5.5% mortgage today might not be a bad thing compared to where we might be in the next 12 months. And actually swallowing an early repayment charge might also not be a bad idea if it means saving some money in the long run. Otherwise, you might be locking into a mortgage that's even more expensive for a minimum of 2, if not to 5 years in the future. However, don't jump the gun just yet. We're already starting to see banks price in a lot of the interest rate rises, and therefore the actual interest rates, the fixed interest rates of the banks, are starting to trend downwards. It started at 6.5%, but we're already starting to see those rates go down to as low as 5.5%. This is because banks are starting to become more competitive again. Part of this is also down to the government committing to extend the mortgage guarantee scheme. This protects lenders against borrowers who are either highly leveraged or riskier first-time buyers. And as a result, a mortgage price war has now begun between some of the biggest banks in the UK battling it out to try and have the lowest rate on the market to re-attract new business. TSB and Nationwide have both reduced the cost of borrowing following a property sales slump, house price falls, and a decline in mortgage approvals. And analysts are starting to say that other lenders would start to aggressively follow suit in this exact same path. TSB reduced its 5-year fixed rates by almost 1.5%, which is a huge decrease compared to what we've seen over the past few months. A borrower who takes out an average £200,000 loan with a new TSB rate at 4.99% would save £1,872 over a 12-month period. When you compare that against the old rate of 6.29%, Nationwide also introduced 0.6% reductions on their fixed rate products as well. Currently, a buyer with a 15% deposit can currently secure a 5-year fixed deal on 4.79%. I expect over the next few months we'll start to see more and more lenders doing exactly the same thing. The big question is how far can they go and squeezing their margins in the process to attract that new business. But all of that is good for consumers like you and me. According to Moneyfacts, the current average 2-year fix is still 5.75%, which is down from the high in October 22, which was around 6.65%. Both of those figures are still very unaffordable for most when you consider how highly leveraged people are and how people want to have bigger, more expensive homes in the current hyped property market. And with no sign of reducing house prices too quickly, it means that buyers are still holding off just ever so slightly to begin to see that dip in property prices in the market throughout the rest of this year. And if lenders continue to have slow business, all they're going to do is continually reduce their rates even further until there is a tipping point in the market. So when you combine the facts that people are holding off to see what happens, and because of that, the banks are getting less business, that's causing them to be more competitive, and they're starting to lower their rates, which is a good thing for consumers. Then you start to look at the Bank of England base rate, and you see that with inflation peaking, we might be in for a good year as things start to head downwards. We could be in for a good ride, which means if you remortgaged now and went onto a fixed rate on the current 5.5% that we're seeing in the market, it might mean that you're actually fixing at what is the current peak in the market, and therefore waiting might not be a bad thing, even if that does mean sitting on a tracker or variable rate mortgage for the next few months on a slightly higher rate. So we have a tug of war. The Bank of England rate is expected to increase, which naturally would increase mortgage rates, but on the other hand, we're seeing mortgage fixed rates go down over time. That's because they're trying to squeeze their margins and they're trying to get more business because it's been so difficult over the past few months. Let's ask Andrew about this. Why are banks reducing their fixed rates despite the increase in Bank of England rates?
Very good question, and again, this is a very, very hot topic at the moment. So my general thoughts on this are, what we're seeing at the moment is, although the Bank of England rate is pushing upwards, it looks to be that the profit margins for the banks are being reduced by the banks, therefore bringing interest rates down. Now, my thoughts on this are that if we look back to last year in October, when the market really was impacted by the mini budget, the banks saw no business. Everything stopped at that point, and everybody was. I was doing meeting after meeting after meeting with the same outcome. Everybody was saying, "I'm going to wait till next year." Now, what I think's happened then is the banks have looked at their data and realised it's better to make some profit than none, and it would appear they've reduced their own margins in order to actually achieve more people moving and keep the business moving.
So we'd already started to see some kind of stabilisation with the mortgage rates even after the Bank of England started to surpass 3%. Back in November 2022, we could see that even though the rate went up for the Bank of England, mortgage rates started to trend downwards, which means that banks have already priced in this risk. They're already expecting it, and it's not a shock like it was earlier in 2022. It also shows that because banks are already pricing a lot of this in, they're already anticipating and expecting the Bank of England to raise the base rate later this year. And this is good news. It means that things might not get too extreme this year. It also means that we can't use the Bank of England base rate and those predictions from the central bank as a way of indicating or forecasting mortgage rates later this year, because now we know they're not corresponding with each other. Now that leads on nicely to the elephant in the room, which is we are addicted and used to cheap lending and super cheap mortgages. It's created a mindset where a lot of us have maxed out our affordability. We've gone for homes that are bigger, in better areas and more expensive because we've been able to afford those monthly repayments. It's not uncommon to see lenders offering 95% mortgages with only a 5% deposit and income multipliers of 4.5 to 5% of our annual household income. So it's created this culture where we're used to cheap lending, we've maxed out our affordability, and we've set our expectations very high in terms of what we can each afford. The reality is now that interest rates have shot up and they're unlikely to go down, there's this period where people haven't accepted that affordability is a lot less lower, and therefore you can't get that nice next big house because you simply cannot afford it in the current market and for the foreseeable future. It also means that if you're currently in a very nice, big, expensive house right now, there's potential trouble on the horizon, because that means that in a few months when you go to get a new fixed rate mortgage, you might be in a position where you cannot afford the repayments on the current property. Will we truly ever see 1.5% interest rates ever again? Let's ask Andrew and get his thoughts. Andrew, we've been used to incredibly cheap lending for years, and it's encouraged people to stretch their finances and move into bigger, nicer homes. Are the good times over with cheap lending, and what impact has that caused on those who stretch their affordability?
So I'm getting quite a big influx of previous customers, as I've been in the industry for 20 years, with that very concern, and it is very concerning because we have kind of got used to that sort of marketplace. Now the mindset does need to change. We do need to understand that period is finished, and I don't think we'll be seeing a return to that in the short term. It's just not a possibility. If we look at interest rates as a whole, low rate lending starts from 0 to 2.5%. Middle rate lending 2.5 to 4.5, and then above that I would class it as high rate lending. So we are teetering on the top of that at the moment. If it comes back into the middle, I still think that's where the market needs to be, and we have trended down towards that point now. From people's perspective, there are other options with your mortgage if you do find that you are struggling significantly. Like, for example, I'm seeing customers wanting to take an extra 5 years on the term just to balance the increase in payments. So that's one of the options. Some people are using their overpayment facilities to try and sort of tackle the balance and see if we can get that down for the future.
And if people want to contact you to discuss their mortgage options, what's the best way to do that?
Yeah, we're a free independent financial services provider. We're funded by the banks. We're happy to look after and support everybody if they need help. Please just contact the email address below and we'll look to book normally a Zoom meeting for you where we can see on screen what your options are in plain English really, so you can really get a good understanding of what your options and what's available.
The problem this creates in the post-pandemic property market is when property prices have surged as high as what they have done over the past few years, and then you combine the interest rates jumping from 2% to 6%, it means that that £500 monthly repayment is now around £1,500. And when you factor in the cost of living crisis, where everything else is already very expensive and households are already incredibly stretched on their finances, nobody can really afford to spend an extra £1,000 a month just to live in the exact same house. This is ultimately forcing people out of their homes into cheaper, more affordable areas and houses, which is the reality of not being able to fix onto a new cheap rate. The only solutions are to put more cash down on a house to minimize your mortgage so that you can afford the higher interest rates, or simply move to a cheaper property where you accept that your affordability has decreased because of the interest rate. It might mean a house in a not as nice area with less bedrooms and simply something that doesn't quite suit the criteria that you needed this time last year. It's important to acknowledge this because interest rates aren't expected to go down anytime soon. This isn't a temporary problem. It's here to stay for the foreseeable future. So if you're holding out for anything special or for interest rates to go down to what they used to be, I fear that you're going to be waiting for a very long time. And when they do go down, I don't think they're going to go down as much as what you're hoping they will do. Where are house prices going and how will this impact interest rates? Well, the latest Halifax house price index has already shown that house prices have gone down 1.5% in the past month alone. They're more than 2.5% down in the current quarter, but year on year, it's still up 2%. Now, I would expect that to start to go down in the next house price index report that Halifax do. As we're seeing the month-on-month decline start to increase now, I would suspect we're now going to see a year-on-year decline, which is the start of the downward trend of the property market. Not necessarily a crash, but it is starting to head down. And with a downward trend in house prices, that could mean two things. If the interest rates remain high, even at 4% as predicted by the end of this year, things may still be very difficult in the property market. It means that people are unable to afford the houses they want, and they might still be sitting on that decision for a while longer. This starts to create a competitive pressure on the lending market because banks still need and want the business, which means they'll continue to lower their rates, albeit squeezing their own margins in the process. And as we're already seeing, as one bank starts to do it, the rest start to follow. Naturally, if banks can begin to find that tipping point that starts to put fuel back in the fire of the property market this year, then that means that prices will start to stabilize because there will be a healthy balance of people selling houses, but also those who can afford to buy. As always though, you shouldn't just look at a property in terms of the short term, whether that's looking at the price of a property today, holding out for a potential dip in prices over the next few months, or trying to hold out for a cheaper interest rate. When you look at the wider picture and you're looking at houses over a long period of time, they have still gone up massively over the long term, which is what you should be really thinking about here. Halifax have called out in their latest house price index that because it's their 40th anniversary, house prices during that time have gone up a massive 974%. So when you zoom out and look at the wider picture, things don't actually look that bad. So my advice there is when you look at the bigger picture, don't let the macroeconomics of the current market stop you from your long-term plans if it means short-term pain for long-term gain. The reality is I can't tell you what to do because it really is betting on the unknown at the moment. We have a lot of volatility right now in the market, so there is no right or wrong. All I can do is present you the facts and the figures to try and help you make your own mind up. I strongly believe right now there is no clear wrong thing to do or clear right thing to do. There's no winners or losers. The Bank of England rate is still expected to increase and inflation is still expected to remain high. However, fixed rate mortgages are already starting to trend downwards by the banks squeezing their margins, which means that holding out might not necessarily be a bad thing for a slightly cheaper rate. On the other hand, inflation is expected to start decreasing now that we've got over that peak, which means if it starts to decrease, the Bank of England rate might start to cool off, which will further bring mortgage rates down next year and the year after. So the question is is it worth sitting on a variable rate mortgage for a temporary period of time before fixing in for 2, 5 or more years? My thoughts on this whole matter is that if you can find something that you can comfortably repay this year and next year, then you should think and consider about that as an option. I think at the moment it really is about survival. It's not about finding the best deal on the market, trying to save hundreds of pounds. It's trying to find something that gives you stability and ultimately something that you can plan towards for the next 1 to 2 years. If you can get through these really tough times, I think that really is crucial right now more than anything else. And that applies to the wider economy. It really is about surviving right now with the cost of living crisis, spiraling costs everywhere, and just making sure that you can get through the tough times. Even if you held out until the end of the year for the expected 4% fixed rate mortgages, that's not the best thing in the world. It's more than double what it was this time last year. So you have to bear in mind, is it really worth waiting for a possible, but not guaranteed, 4% fixed rate compared to the 5.5% that we're seeing at the moment? If you enjoyed this video, then check out this one here, which explores whether you should buy a house now or wait until next year. It's handy if you're a first-time buyer or looking to move house. So if you're interested in that, click on this video here, and I will see you in the next video.